Welcome to the ProVest Pulse. We are on episode 8. I'm Gabe Lopez, and with me, as always, the handsome Peyton Hoppus. Well, not that handsome, but
flattery right off the bat, folks. You know it's going to be a fun time. Listen, super glad you're here, Gabe. Thanks for the intro. Excited to be on this episode again. Now, we're going to try and keep this short and sweet for everybody. So we're going to jump pretty much straight into it. We're talking about the market and income strategies with a little bit of Fed and inflation talks. So we'll get right to it so you can get the information inside your brain as fast as possible. Gabe, what we got next on this one, it's a little bit of the year-to-date review. So tell me what we got.
Yeah, all the cool data to go over, not a lot of time. So year-to-date, this is a chart of the year-to-date performance of the top performing sectors of the S&P 500. So if you guys remember back in 2025, energy was a big underperformer. Technology was all the hype because AI in 2025 was the headline everywhere. That being said, as what we look for is opportunities that might be overlooked. Energy was something that caught our attention last year. Energy this year has been the main proponent of the outperformance in the sector. So you'll see the percentage return of the sector on the left, as well as the timeline on the bottom. And it's broken down into energy, industrials, materials, technology. You'll see in the background which is beating which during that time frame. But Peyton, I think it's safe to say that is a green graph. So energy has been taking the podium consistently throughout the year. But with that being said, as much as we loved energy this year, it's something to keep an eye on to not overdo our britches, I guess is a good way to say it. But anything to add there, Peyton?
Yeah, this is a little bit of what the top performers are. That does not mean everything else is left for dead. So the next slide, Gabe, that we go to is going to break down this a little bit differently when it comes to returns. So diversification is leading in 2026. Now, typically diversity means maintaining wealth. You have a lot of different positions that are giving you exposure, so you're not super concentrated, and that volatility, left behind, bad returns are really hitting you. So diversity helps maintain a certain level of consistency. But what we're seeing is diversification in year-to-date returns all across the market, everywhere from large cap value stocks all the way to the Mag 7, which are now the Lag 7K. We follow some guys who are big on that. But between that difference, the large cap value stocks are 21 points higher year-to-date return than the Lag 7. And then everything falls in between of that, but international, emerging, small cap, real estate, they all play a different role and they all have a different exposure point for a different reason for our clients. But almost everyone has a very similar exposure. We're going to give ETF exposures to these sectors at some form or another. And then we're going to focus on overlaying that with more real estate, more energy, more technology, or less of those areas because we may already have enough weight. So this is just simply saying this year, if you focused only on the tech and the Mag 7 in the tech sector, you actually left a lot on the table for what could have been.
Right. Well, let's talk a little bit about what might be causing those fluctuations and those distances. One of the things that we look at regularly, Peyton, is the VIX, the Volatility Index. You recently read the definition. What's the definition of the VIX again?
The definition of the VIX is basically the market's expected move within the next 30 days measured out in volume. So if somebody's going to, or if the market as a whole is trading 10 million shares of everything across the market, which is a low number. That's not the real number. And then we're expecting for it to be 30 million in the next 30 days. That would be an increase in the VIX or an increase in volatility and volume. And that might be a good thing, or it could be a challenging thing against us. And so left-hand side on this chart is showing us the relationship and the average daily return for the S&P against the average change in rate for the VIX. Now, they're inversed. So when the S&P is grinding higher consistently, lower and lower volatility seems to happen. And then once we get down to lower and lower volatility, not all the time, these are historic returns, they're not future returns. We're looking at a chart that goes up to 2017. We see that there's sometimes a pullback, or there's sometimes trading sideways, or we go down 10% or 5%. Usually the VIX is then increased during that period of time because people are trading out of one position, maybe into another, and that creates volatility. And then that goes typically in a given year until about October, November, and then up and to the right. And so seasonality VIX looks very different. We've already gotten above average VIX changes in change rate from earlier this year when the war kicked off with Iran. And then into the summer months, we kind of see that averaged out a little bit. It's a little bit more normal for historical standards. But going forward, Gabe, that's something that we are aware of, that between now and the midterm election, we could see volatility or the VIX kick up. And that would mean a pullback at some level, in some sectors, and not everybody's account, but just in general, a pullback all the way until midterm elections are solidified.
Right. So keep an eye on what history has done in the past, but necessarily it might not repeat. But it's safe to say if a meteorologist is calling for rain and it's a 90% chance of it happening, we're going to be preparing for rain. So let's take the proper precautions. That being said, let's talk a little bit about what might be causing the VIX to spike as much as it could be in the later part of this year. The Fed, interest rates. If anybody has a high yield savings account, a CD, you get an interest rate that is largely based around what the Fed is deciding and what the Fed's numbers are at. So the September 15th meeting is a big thing that we at ProVest are looking at to make sure that our investment theses are playing out and our trend following is playing out. So talk a little bit about what we're seeing in hedge fund managers' decision making as well as the overall markets, because I know we have a poly market graph in here as well as what other peers like you and me are thinking about what might happen September 15th.
Yep. So fund managers are going to be hedge funds. Think JP Morgan, think Bank of America. These fund managers are being surveyed, and they think that 72% think that there's no rate hike coming in September from the Fed. And then there's 22% of them that believe that there might be a rate hike coming in September. And then this is as of August of 2026. So that's the fund managers. Now, controversially, most of the time, just because everybody's facing north doesn't mean that's where the wind's coming from. But in this case, we do see that the retail side, or the people on Polymarket, which is a betting platform on anything in the world you want to bet on, this one happens to be the probability of the Fed decision and the possibilities of what that could be in September. And most everyone is in alignment with the Fed managers. 68% say no change. 33% say yes, there's going to be some kind of hike. And so everything else is less than 1% probability. Here is what I'll point out, Gabe, is that if the Fed does hike rates in September, 25 basis points, there is going to be a little bit of a whipsaw effect because everybody, by and large, is expecting it to not happen. What we like to do is prepare for potential rain. If it doesn't, we can just put our coat right back up and go back to business as normal. And so that's something we're aware of. And we're trying to find, we don't want it to necessarily go down, but we're trying to find a catalyst in what could be the slow grind down into November through September, October, November, based on something. Something's got to trigger it. And so we're trying to figure out, outside of seasonality, what could push us into a drawdown in various sectors of the market.
Right. And speaking of triggers, so if the Fed's decision will cause a VIX spiking, what would cause the Fed's decision? Biggest thing that can cause their decision is inflation and job numbers. But let's talk about inflation because this is what's affecting everybody. If you're buying milk, getting gas, if you're trying to buy the new Lego at Walmart, these are all things that are affecting everyday people. So what we have here is the graph from the economics of U.S. labor statistics on what inflation has been looked like month over month since last July. So things have been pretty stable, under 3% since about February, March. May, we had a big spike of 4.2% that month because of the war. But on average, since last July, we're looking across the board 3.4% of inflation, which is not as great as the 2% we'd like to hit, but you get a little bit of a better number if you take out the food and energy department. That's hovering at around 2.5%. So obviously nothing that we can bat an eye at. Things are slowly cooling off, but we'd like to have it cool off even more. Peyton, anything to add there?
No, I think our next slide is going to cover this pretty well. And we're going to talk about how this inflation number is eating into your dollars you're leaving. And so how do we approach this? So these are all what's happened, what could be. We don't know in those last two slides what's going to happen, but we're just kind of presenting it to you as a matter of fact of what we're seeing. But here at ProVest, for our clients who are in a position where we want to really protect purchasing power, maybe you're towards the back of your career, and it's something we want to start looking at is building a dividend portfolio. We have a dividend value portfolio, and it's around high quality stocks, so total return focus with a discipline of pursuing capital appreciation. So your dollar should grow, it shouldn't just produce an income, as well as income growth. So we want that dividend to grow over time. An example quickly is this. Warren Buffett's Berkshire Hathaway company bought $400 million worth of Coca-Cola between 1988 and 1994. They have not sold, and they held. That valuation in Coca-Cola is now worth over $1 billion. Here's the crazy and powerful part of that is their dividend is now over $1.2 billion they get a year. it's split. So they're of course going to get more shares if they already own 400 million. The shares split. Each share gets a certain dividend, and they grow their dividend. So it's like compounding interest on steroids when you hold it like that and you hold it for that long. Now, maybe your position is $40,000, but that could be over $100,000 in the future, and it could produce $100,000 in income. So dividend growers and dividend value is a really big piece of what we like to focus on in interest rate environment times like this. If they cut, dividends become much more attractive. If they raise interest rates, good quality cash flowing companies become very attractive, and we're attracted to both almost all the time. So what we look for is high quality companies, strong cash flow, and a good dividend coverage on everything that they're producing. We want to make sure it's a very simple company to understand. We want to make sure that they grow their dividend over time or have a history of doing so. And then we're also opportunistically looking for the company that's maybe got an 8 or 9% dividend because their price has been suppressed. Now we need to find a reason. We need to have a catalyst that they're going to get out of that depression as far as in the stock price. But if we can buy your dollars in at 9% and hold it for the next 7 to 10 years per se, then you're getting a 9% return on those dollars that went in, no matter what the price goes to or what the dividend rate is in the future. And so to beat inflation, we really like to try and do that with dividends instead of just putting your money in a money market or a CD, where it's really not beating inflation because it's keeping up with the inflation number, and then you take out taxes and you're losing the inflation number. So there's a key part of this that's a good strategy to build in for people who are looking for a little bit less volatility, but focusing on growth and income long term.
Yeah, I don't know about you, Peyton, but I'm always interested in having a paycheck that's growing over time and not staying the same over time.
That's right.
Just to keep that up to date. Well, hopefully that was informative to y'all. We love doing the ProVest Pulse. So if you guys have anything that you'd like us to talk about, me, Noel, Peyton, any topics, anything specific, please feel free to reach out to us. We'd be more than happy to discuss it. Take some time to pause your screen and read the disclosure. Thank you guys so much for tuning in to another episode of the ProVest Pulse. We'll be back soon with another episode. This is Gabe Lopez and Peyton Hoppus signing off this week. Adios, y'all.
See ya.